Welcome to the Powering Change series with me, your host, Keith Moran, Group CTO of CubeMatch. Presenting our RegTech roadmap today with Chad Giussani, Managing Partner of Regulatory Reporting at CubeMatch, and Francis Kiwanuka, Head of Risk and Compliance at CubeMatch, both based in our London offices. CubeMatch is a global change and transformation consultancy, powering change for financial institutions. A big thank you to my colleagues, Chad and Francis, for joining me and coming over from London for our series today. And I guess, Chad and Francis, I'll come on to yourself. I'll ask you the first question about MiFID. It is more than 5 years since MiFID has gone live. Are firms still discovering issues, and are they doing back reporting?
They still are discovering issues, Keith, in a number of different ways. So the FCA are constantly looking at the MiFID transaction reports, and where they spot errors and omissions, they'll get in touch with the firms to ask them why these are arising in their reporting. Firms often have their own quality assurance program around regulatory reporting, and that tends to discover lots of errors and omissions. They need to be identified, assessed on when they started, how big they are, how long they'll take to get fixed. The firm can then make a material judgment on whether or not it needs to inform the regulator of that errors and omissions. And that's typically done by an errors and omissions form that you can get from the FCA's website. You upload your content of that form, fully completed, and then the FCA will be in touch with their questions.
Yeah, and Chad, do you find the FCA are helpful in addressing client queries, etc.?
They are incredibly helpful. So you can enter into a bilateral conversation with them. Where they spot themes, they might put something out in an FCA market watch. They're very often doing that around transaction reporting. They might say, here are the top 10 things that we spot firms doing wrong. They might talk about specific areas around the regulatory reporting. So things that we've seen them talk about recently are aggregation of trades, or we've seen them talk about LEI relationships and parents and branches. So they offer really helpful guidance when they see thematic issues going on.
Perfect. Thanks, Chad. Chad, how is CubeMatch helping back reporting and other client-friendly initiatives?
So yeah, when you spot an error and omission, you then have to correct the error. The current guidance is that you only have to go back 5 years, and that's on a kind of rolling time frame. FCA are not interested in reports older than 5 years being corrected. But we can engage with clients in a number of different ways. We can supply subject matter experts to come in and help a firm on a quality assurance and discovery process. We can work with their existing vendors if they've already discovered errors and omissions and want help with the corrections. Or we can work with our partner firms where we have specialist firms that we can engage with who look at back reporting holistically and on a wholesale basis and are able to effectively manage programs of back reporting. So you could imagine a firm might have a problem that does go back 5 years and it has 1 million plus transactions to back report. There are certain firms out there that specialize in doing just that type of work where your current vendor stack might not be so well engaged with it.
Yeah. And obviously yourself and Francis are very deep industry experts from a regulatory perspective. But I guess for some of our other users or watchers today, etc., can you explain from your own perspectives, what are the main differences between SFTR, EMIR and MiFID from a regulatory perspective? And Francis, maybe just over to yourself for this question, and obviously Chad as well.
So one of the key differences is that the EMIR covers the OTC products, and they're of longer duration, whereas SFTR are shorter durations. It involves resets, collateral exchanges, and as a result, it has more fields to report and therefore slightly more complex.
Yeah, from my perspective, MiFID precedes SFTR and EMIR. MiFID's been around. Prior to MiFID, it was Investor Services Directive, late 90s, early noughties. And MiFID is very much about market conduct. So the transaction reporting and trade reporting are for the benefit of the end investor. What we see with SFTR and EMIR is that these are post-credit crunch regulations. And that was where the regulators discovered they kind of had blind spots in their vision of the market. And so they plugged those blind spots. They started with the derivatives regulation. So we saw Dodd-Frank go live in the US and we saw EMIR go live in Europe. SFTR was added to the stack a little later, and that was to cover the blind spot around the shadow banking in part of the industry.
And I guess, Chad and Francis, do you view the latest updates across the regulatory environment as progressive or onerous from a client perspective?
I would say from a client perspective, it's onerous. And the reason is because, the regulatory landscape has become more complex. The demand on clients is actually very costly, because, they expect, much more robust infrastructure. So yes, it's become more onerous, and I don't expect it to change in the short term.
I mean, it's definitely both, right? So it's onerous for the clients, but it's better for the regulators and for the market as a whole. We've just seen the EMIR Refit go live, which aligns EMIR a lot more closely with SFTR. That's a big uplift in complexity. But what the regulators have been very clear on is that is not the end. They see that as a significant step forward, but not the end of the journey for reg reporting. So we're on a path somewhere. We're already talking to the trade associations around EMIR 3.0, so the next steps. And MiFID also will be revised again. SFTR, I think Francis will talk to later, is currently up for a revision as well. But certainly, we've been speaking to the MEPs and that are representing the European Commission, and they've got plans to extend EMIR reporting once again. And the MiFID review is currently underway, and there are significant changes there as well.
Chad, that leads me nicely on to my next question. Given EMIR Refit has just gone live, what are the current EMIR back reporting implications post Refit implementation?
So the back reporting, if we split it into two, there's something called backloading. So when you get to the next cut of EMIR, anything that's live and outstanding, as Francis says, you've got some derivatives out there that last a long duration. They have those reports have to be upgraded to the new standard. And the challenge there is that you've got a transaction that maybe took place a number of years ago, and you now have to find extra data elements around that transaction that you probably didn't capture at the time of entry into it. So that backloading becomes a problem. Firms are given 6 months after go live to complete that. Most firms tend to do that up front. What we then see is the back reporting. So when you encounter an error as an omission, typically an omission might be a failure to report, an error will be an incorrect report. What you see there then is that firms are being obliged to back report. And we've always had to do that under EMIR, but where it gets particularly difficult now is that the European Commission and ESMA have agreed that you now have to back report the collateral data and the valuation data. And that's not something we've ever done before. And arguably, many firms see particularly the collateral data as somewhat disposable. So under the previous version of EMIR, with the trade repositories, if you back reported a collateral value, it got immediately overwritten with the latest value. It's called latest is greatest.
Yeah.
But what we're seeing now in the guidelines is we are being asked to back report all of the history of missing collateral or valuation data. Typically, that's been some low value data and not something that firms have stored. And now they're having to store it only for the purpose of back reporting.
Excellent, Chad. And I guess across our client base, we've seen a mix of in-house versus delegated reporting, and we've seen different models being implemented. What are the main questions firms face when deciding whether to delegate reporting or keep it in-house, and just some of the challenges associated with such?
I mean, I think the first thing that is important in terms of delegated versus on reporting is that even if you delegate as a counterparty, you are still responsible for the reports that you send to the TR. Yeah. So the choice is not that if once you delegate, then you're absolved of all responsibility. Now, in terms of both delegated versus self-report, there are advantages and disadvantages. But Chad, perhaps maybe you want to talk about some of the disadvantages.
Yeah, I'll start with, so EMIR Refit, the reporting went live earlier this year, but actually the EMIR Refit was introduced a fair bit earlier. And in there, they introduced the concept of mandatory delegated reporting. These are for the smaller non-financial counterparts that trade OTC derivatives. But if you're a bigger, smaller financial counterpart, or you're a bigger non-financial counterpart, or you trade ETDs, you don't have the benefit of mandatory delegated reporting. So as Francis said, that means that even if you can delegate your reporting, you still have the obligation of that report. So if there's something wrong with that, you are responsible, not the person that did the report on your behalf. So that then leads you to a dilemma. Is it better to self-report, or is it easier or more convenient to allow a third party to do so? So people use the EMIR Refit, which was a significant uplift in the complexity, to readdress that conversation internally at their firms. A number of bigger buy-side firms have decided that they potentially could see benefit in delegated reporting, and so have chosen to go with that model. The problem there is it's like letting go of the handlebars. So where you've done your own reporting for a number of years, you are in full control. You know your errors, you know your omissions, you know your book of work. You can negotiate and manage with your regulator the delivery of that book of work. The problem when you go for a delegated model is that you rely on your counterpart to fix the problems, and you still have the obligation to check for them. So if you discover an error with the reporting, you have to go to your counterpart and you have to say, I've spotted this error. When's it going to be fixed? Why has it arisen? Because I need that from my own my own declaration to my regulator. You may be one of a dozen clients, maybe more, with errors and omissions problems. How does that reporting firm decide who to prioritise and how to prioritise? Sometimes firms have used their kind of leverage and said, right, well, I'm one of your platinum clients, so I'm going to stop trading with you for a month until you work this stuff out. But they can only play that card so many times before everyone else has played it. So it starts to have less value. So for the reporting firms that offer a delegated service, it's a big problem for them now, because they have obligations to inform their own regulators, your regulators, you as well. There's a whole section in the guidelines on how ESMA expects this delegation to work and how the errors notification problems should be notified to people. Trade associations have got together to work on this problem, and there's no clear answer. So we've had to go back to ESMA and say, these are the bits of what you propose that work, but these are the bits that we either don't work or we can't understand. That's an ongoing process. Errors and omissions always been a problem, but once you delegate, you are passing control, and it's that lack of control that might see some firms bring it back in-house.
Yes, and I think the other thing that I would like to add is that we have seen real-life examples with our clients, and Chad alluded to that earlier, where they have identified issues to the delegate reporting party, and the lead time to fixing the problem it goes even up to 3-4 months, and that obviously hamstrings the counterparty in terms of when to remedy the issue.
So I think I know the answer to this, Francis and Chad, but I'm going to put you on the spot now. You're setting up a new hedge fund. Would you go delegated or in-house? I'll start with Chad.
Setting up a new hedge fund, quite topical with me at the moment, as we've just onboarded a new client for reg reporting, brand new hedge fund. I would say where possible, delegated is good to get you off the ground, because you're relying on a more established third party to do your reporting. I think once your fund gets to a size and your trading volume gets to a size, that's probably when you'd make an educated decision about whether or not you're happy with the counterparts that are doing the reporting on your behalf. The problem with using a delegated model is that it does limit who you can trade with, because you can only trade with someone who can fulfill the reporting obligation on your behalf. And that doesn't always suit a new startup. So it's a commercial thing as well. You probably want self-reporting as a backup.
Yeah, but a key message, find the right partner there.
Absolutely.
Francis?
No, I totally agree. And also the other thing that, say for instance, if you find a partner to help you with the self-reporting, you benefit from the economies of scale, because they are doing it for several clients, and therefore it's more cost effective.
Francis, I guess just over to yourself as well, and now we're going to talk a little bit about BASEL 4, etc. Can you just please share your thoughts on BASEL 4, the regulation itself, and from your experience, what are some of the key challenges clients are facing?
There are numerous, but I think the ones that stand out is basically around data. Data quality is an issue. Basically meeting all the stringent requirements around completeness, accuracy, timeliness. That is always going to be a problem. The other thing is the cost of infrastructure. A lot of our clients tend to be tier 1 banks, and they have quite major infrastructure, some of it which is legacy and some of it that is even, it's been data has been migrated to cloud. So how do you bring these two together? So you could deliver change very quickly if the infrastructure is in cloud. But if some of it is still in legacy, it's almost like agile versus waterfall.
Yeah, perfect. Thanks, Francis. Just switching gears slightly. Obviously, corporate sustainability it's now a permanent topic at board level conversations for every single one of our clients, right? And we all recognize that's very positive. But in relation to CSRD, which is the Corporate Sustainability Reporting Directive, what are some of the opportunities and challenges that are being faced by our clients in terms of implementing CSRD directive?
I think the main one is buy-in, because it doesn't seem to be, to a lot of our clients, a tangible benefit. It's slightly obscure. So they tend to find buying internally very challenging.
I'd say that's one area where CubeMatch can help a client, is articulating what the benefits of implementing the regulation well are. The sustainability, the publication, what that means to your counterparts and your clients, what value they take from that, why they might pick your business to work with as opposed to another. That's something where we can help.
And I guess my final question on that, it's a topic I'm really interested in as well. If you get your CSRD reporting, to a level where it's best in class, etc., do you feel that can lead to a competitive advantage for a firm?
I do, yeah, definitely.
Definitely.
That's probably the biggest point of doing it.
Yeah.
Aside from being compliant.
Yeah, and I don't know whether in the future there will be naming and shaming in this area, and basically, basically rewarding those companies that actually meet the regulation versus those that don't.
And we have seen the FCA post out a newsletter recently, kind of slightly naming and shaming. What's your thoughts on that?
Well,
I think it's done to make firms feel uncomfortable.
Comfortable.
Yeah, it's a different approach. It's a controversial approach. Whether it lasts is a different thing. But naming and shaming, transparency, I'm all for it personally. In everything in life, transparency I feel is a good thing. And if it makes firms try a bit harder, then it's working.
Yeah. Okay, so moving on to our last topic, and Francis, this is your area of expertise as well, obviously supported by Chad, Security Finance Trade Regulation. And we've seen some of our clients, they've just finished implementing SFTR, they've been compliant, etc. But now there's talks of SFTR 2.0 coming up on the horizon. Francis, can you talk to me a little bit about that and what changes our clients could expect to face with 2.0?
I think with 2.0, the main change is going to be the inclusion of ESG, as I mentioned earlier, and that will obviously translate in more attributes added to the already existing 155 attributes. So I expect it to become even more complex. I think that's going to be one of the main changes.
The evergreening of EU regulation is inbuilt. It's part of the Lamfalussy process that they use to look back, look at what went well, what didn't go well, and what to do next with it. I think incorporating things that sit aside the regulation's original intended purpose is never a bad thing. And if ESG is what they strap onto the side of it, then I think that's a great move. It's probably a better way of doing it than thinking up something new for it.
Yeah. Perfect. And I think as a general observation, right, we're seeing across the regulatory landscape, it's not going to abate. If anything, it's going to increase. Any thoughts on that?
Yeah, I mean, I remember MiFID 1 going live in 2007, and by 2008-9, thinking it was all kind of done. And then we had the credit crunch and the shock from the derivatives market, and that kicked off everything else again. And I think what we see now are there are going to be constant refinements and improvements and amendments. The EMIR Refit, whilst it did impact the reporting in a big way, also impacted other areas of EMIR regulation and made it more proportionate for the market participants. Because there are all types of people that trade in derivatives, from your big banks down to your small firms that need to hedge for FX risk. And dragging those guys into a great big full-on reporting obligation was probably less appropriate. And so it's good that they do this look back and say, right, we've seen it work well here, but actually it's onerous on this market participant, and we'll remove that part of the obligation.
Yeah, thanks, Chad. And I guess, Francis, just switching back, right, because SFTR, there's various product types, there's repos, there's sec lending, etc. Like, what are the biggest challenges that clients face in terms of being compliant from an SFTR perspective?
Depending on the client, we have come across different permutations of challenges. For instance, very recently, we're working with a rather sizable client, and the initial part of the engagement was basically we were just going to be delivering vanilla repos, but then once we delved into the subject, we ended up basically delivering evergreens, extendables, opens, in addition to securities finance, securities lending margin, as well as buy-sell backs. Each time we engage a client, we try to obviously reduce the scope of work that needs to be done, but it's mostly driven by the front office as to what we eventually deliver. So yes, it's very, very, very complex.
Now, I'm not going to get into the subject Brexit, because I think we could be here for quite a while, and we've all very firm views on Brexit, etc. Right? But I guess a question, we've clients across obviously the EU and the UK. Is there any differences between the legislation from an SFTR perspective across the European Union and the UK?
There is. I mean, and I think Chad touched on it, and when we talked about EMIR, and we talked about EMIR Go Live. EMIR Go Live, the recent Go Live has been EU, and then in September we'll have the UK Go Live. Similar to SFTR. There's subtle differences. For instance, non-financial counterparties don't have to report SFTR in the UK. Most of the regulation has been basically cut and pasted on the statutory books, but there's subtle differences, and I think the FCA is basically, I'll maybe use a very colloquial phrase, pick and mixing, based on what is going to be suitable for the UK.
Yeah, that's definitely one outcome of Brexit, is that the FCA and the Bank of England now have what they call regulatory flexibility, which means that they have been able to, for example, suspend that phase of SFTR reporting because potentially the UK wasn't as bought into it under the European Commission's proposals as perhaps they should have been. And it's a great chance for them to say, right, we now have the control to be able to suspend that part of the obligation. And it's happening in all sorts of places. We see it in MiFID, we see it in EMIR. They're broadly in line, kind of equivalent with what the original regulations were, but we are starting to see bigger divergence.
Yeah. And I guess my final question, Francis, back to yourself in terms of reference data. We're seeing that as a challenge that some of our clients, particularly high volume trading clients, are seeing. What would your advice be to clients in terms of managing reference data from an SFTR perspective in line with other regulatory frameworks and data?
With all our clients, we always go in with, quite open-minded in terms of what's there, and then we basically do all the necessary analysis in order to identify the gaps that exist. Some of the key areas, I think I touched on this earlier, apart from data quality, there's a lot of work that we do around translation of the data, or, through their ETL layers, extract, transform, and load layers. But also, we do quite a lot of work around normalizing their data, helping them define their target operating models, target functional models as well. Just basically, helping them again with their accuracy, their completeness, and the timeliness of their data, and that includes their reference data, because they, especially when it comes to reference data, most of our clients have different sources that where they pull their data, from the various external vendors, and basically just helping them normalize that. And so that all their functions functions and portfolios basically speak with a single voice.
Thanks, Francis. And I guess just a couple of other questions and then we'll wrap it up, right? And I know there's no one size fits all here, but I guess I'll just kind of hand over to yourself, Chad. From a MiFID perspective, and I know we've one active client at the moment, what do you think is the best case scenario in terms of implementation timeline?
Yeah, so I mentioned earlier that we're engaged with a new hedge fund. It's not often you get to work on a completely greenfield site, and they have pressures on them to commence trading. And the challenge they set us was how they wanted to start MiFID reporting from zero to full reporting within 6 weeks. My personal record for EMIR reporting was 14 weeks for a large UK bank, but 6 weeks has been quite a stretch. Didn't quite hit that. I think we went live on week 10, but again, that's somewhat unheard of. Normally, and I remember being around the MiFID programs from 2018, the reporting programs took longer than 12 months. So to be able to go from zero to reporting in 10 weeks is somewhat impressive. Not without its issues, but those are things that we work through with the client.
And now the client is reporting, obviously, Chad, in a compliant manner to the FCA.
That's right, and they're trading, more importantly. So they've hit their own targets.
Fantastic. Francis, SFTR, what would be your view of an aggressive but an achievable timeline for a client that wants to implement SFTR reporting?
We would say, depending on the number of products they are trading, but I would say roughly 6 months. Roughly 6 months. I mean, one of the advantage of CubeMatch is that we have a big pool of talent to draw from, and most of them are industry experts, SMEs in the field. So they hit the ground running, and they require very little supervision. That's one of the advantages we have on some of our competitors.
Yeah. And I think as well, guys, that leads me into kind of my last question, right? Because I know it's all, we kind of know this extremely well, but can you just give me a flavour of what would be the size of the teams and the type of resources that you would be needed to implement, I guess, Chad, with yourself and EMIR MiFID project, and just a flavour of maybe some of the teams that we currently have in place actively delivering for our clients?
Yeah, so for the hedge fund, they had their own tech team. They have their own compliance team. So really, we're building a team of subject matter experts and some support around the governance model. So you're not talking about a particularly big team, but what you are talking about are people who are able to thoroughly assess and review the quality of the reporting and work with the client to improve the quality of reporting prior to submission. And there you're talking about a team of maybe 3, 4, 5 people. It's not a team of 20 anymore.
Yeah, and I think that's surprising for me. Well, it wasn't surprising for me, but we had a project manager who's also a subject matter expert. That was yourself, Chad. We had a PMO who was a relatively junior resource, and then we had 2 industry experts with 15, 20 years plus, which seems to be a theme. Well, it's one of our USPs from a CubeMatch perspective. Francis, on the SFTR project,
we had similar numbers, and the reason was because like similar to Chad, the tech resources were brought on by the client. I mean, obviously here in CubeMatch we do have that capability, but if we don't, in terms of an engagement, we work very closely with the teams. One of the areas that, beyond doing the analysis and giving the SMEs, advice, one of the areas we tend to want to retain is the testing, the UAT testing, especially, with the users, because that basically, gives us confidence that we're actually delivering, a good final product. So we normally would take charge of UAT testing all the way to the trade repositories.
That's certainly an area where we add big value, is that with the UAT testing, you can get a transaction report through to a trade repository, through to an ARM, and it's syntactically passes all of the validations. But does it semantically make any sense? Does it reflect the transaction that took place? And passing all of the technical validations does not ensure that. So having an SME eyeballing a report, writing a proper test case that says, this is how this type of instrument traded that type of way gets reported. That's where we add the value.
Yeah, and I guess, Chad, we were on a call last week with a client around even correct ISINs that the client thought were correct, that indeed were not correct.
Yeah, I mean, just understanding how ISINs work and how the financial instrument reference database works, both UK and Europe, how its nuances are, and how the concepts of TOTV and UTOTV, they're not simple concepts for someone just to pick up immediately. And our SMEs have years of experience with those concepts.
Yeah, thanks, Chad and Francis. I guess, guys, just to wrap it up, we've gone through a fairly significant at pace regulatory framework from EMIR to MiFID to BASEL to SFTR, etc. What would be your final pieces of advice to clients? Maybe your one or two top tips that are looking to implement maybe MiFID and EMIR, Chad, from yourself, and BASEL and SFTR, Basel 4 and SFTR, Francis, from you. And I guess I'll just start with Chad. A difficult question, Chad.
I think it's probably a Crocodile Dundee thing. It's sleep with one eye open type thing, right? You have to keep a constant eye on the regulatory landscape. It's constantly changing.
Yeah.
If you don't engage, then you have no input. So you become a receiver of the change. Work with your trade associations. If something doesn't work for you, make your trade association aware. Other members may agree. They might take it back to the consulting parties. And we do see change go through. There was something that went through under EMIR, the next round of EMIR, where they were trying to push a obligation for subsidiaries outside of the EU. And we kind of brought that up with ISDA, and ISDA took it back to the MEP, and the MEP agreed to remove that part. So that was a really good win.
Sensible conversation.
Exactly.
They can't be had, Chad. They can't. Pragmatic, indeed.
Yes.
That's the word I'm looking for. Francis.
I think what's important is you need to establish a relationship with the client that basically is not just, you're not just there to deliver the specific engagement they've asked you to come in for. You're there to identify any gaps that might not necessarily be under your remit, and constantly work with them to ensure that that you actually add value to their business, rather than just going in and delivering something and just walking away after delivery. You've obviously achieved your objective, but not necessarily added the most value that you could.
Perfect. Chad, Francis, I know you're extremely busy people, but I'd like to thank you for taking the time to have a chat with us today. So I guess in conclusion, thank you everybody for watching the show. If you've enjoyed the content, please follow us on the usual social media channels like YouTube, LinkedIn, X, etc. And again, if anybody watching has any further questions or would like to find out more about CubeMatch's services, please go onto our website and contact us, and we'd only be delighted to help answer your questions. Thank you very much for watching the show.